affect Singapore's real estate. Last but not least, I'm going to bring you through history, okay? The past cooling measures, how it actually affected Singapore's market. We have the 2013 cooling measure, we have the 2018 cooling measure, we had the 2021 cooling measure, and I'm going to hypothesize a little. Q3 2022 cooling measure, how this is actually going to affect the market, okay? And then I'm going to give you the macro real estate investment journey that our team has been preaching since day one, and you know how this is actually very robust, that it can protect us from such measures as well. And later on, I'm going to pass the time on to Chris, who's going to share with you how he actually owned 9 properties at 25. And I can share with you one thing, you got to stay till the end, because Chris didn't come from a family of wealth, right? He actually came from a family that is suffering from financial difficulties, and how he actually managed to turn around, right? Even though his family didn't make the best decision in real estate, how he managed to turn around to earn a 5-figure passive income. Okay, I'm going to share with you again, this is a no selling cost. There's not going to be a cost that you're going to pay for at the end of this session, but the whole purpose of this is just to value add and to be that alternative opinion in the market, right? And to be the objective opinion in the market as well, okay? And at the end of today's session, we have discussed, we are going to share with you the specific portfolio strategy for 4 groups of stakeholders: millennials, first-time buyers, upgraders, multiple property owners, and last but not least, downgraders as well. Alright, so just a short introduction about myself. If it's the first time you are seeing me, hello, thank you so much for being part of this webinar. People know me as the founder of JNA Real Estate, and just in short, right, this team was started in the year 2017. I actually started real estate investing and bought my first private property in Singapore at 22, and actually I was the champion team leader for the past 3 years. So I did a double degree in law and business management, and actually specifically in real estate finance, because I really have a passion in real estate, and we actually sold 1,000 homes collectively as the whole JNA Real Estate in the year 2021 and 2022. And you may be asking me, what drives me to do what I'm doing right now? Because I believe that as the future generation, as the team that believes that we are the brand of the generation, we need to provide that true and the objective value in today's marketplace. And we don't want to be crowded by the noise. We don't want to operate based on FOMO mentality. Most importantly, we want to make sure that we make the right decision, and the prudent decision, and not only that, the accurate decision as well, okay? So just some things about us. This is actually being powered by JNA Academy. So we have done a lot of such webinars and seminars before, whether is it Facebook Live, YouTube Live, we're actually live almost everywhere. But whenever there is a policy change, be sure to ask your brokers, right, for that consumer seminar, because you will be responding ASAP, because you want to make sure that we are on top of it, okay? We want to make sure that we are on top of it. So what is our marketplace and purpose and mission, right? I'm going to share with you why we decide to do today's webinar, and share with you that driving force, right? If we're not selling you anything, what is the reason why I want to do that, right? Because in our team at JNA Real Estate, we believe that we want to provide that true and objective value, okay? And we just want to make sure that, similar to how we have benefited from real estate investments, we hope that every single one is also able to benefit from real estate investments and not get burnt like some individuals out in the market, where we've experienced clients who had such predicaments before, right? So two main things that we focus on. Number one, objectivity in investments, and number 2, being operationally excellent in selling homes. Okay, so I think you've seen our videos before. We have been selling homes quite a little bit as well. So I'm just going to share with you a little bit more about ourselves, right? Some newspaper articles about me, and also if you hear every Wednesday, usually Wednesday or Fridays, you can hear me on air, right, at 987 FM, and you know, I'm a host there. So anything about real estate, do talk to my brokers at JNA Real Estate, because they are all very well versed. They have been trained. We have 9 training sessions monthly to make sure that all of them can advise all you clients properly as well, okay? So sorry, I think there are some phones that are not being silent. Yeah, okay, great. Is it mine? It's not mine. Okay, great. So this is just my journey of my investment in real estate as well. I'm slightly different from Chris in the way that Chris is, you know, he buys a lot of properties. For me, I believe in the sniper mentality. I aim for one that I see full potential in, and I go for it. So when I was 22, I bought this condominium at Twin View. I sold it just the start of this year for a profit of close to $200,000. And then after that, I used this amount that I have plus the down payment that I had to buy kind of a matrimonial home and also an investment home at Mayor Mansion in 2022. Okay, so
I can't see anything.
Oh, okay. Give me a while, sorry, because this is the first time doing it. Are you able to see my screen?
You say you cannot.
Cannot see my screen, is it? Okay, it's fine, it's fine. Let's see. Give us maybe a minute or two as we solve the technical issues. There are a lot of tech in front of us right now. Is it working now? Are you able to see my screen right now? No, I see myself. Yeah, correct. Yeah. As in I see my own face there. Yeah.
It's correct. So if you lose this, you have to let me know.
Okay.
I see, I cannot see the screen, but I can see you only.
Oh, only can see me, is it?
Yes.
I'm so
It's
sorry.
not
You have been
featured on
looking
the
at me
screen.
in the background.
Now it's okay. Ready, go. Calling you, I think it's okay, Jervis.
Are you able to see the screen?
Yes. I'll show the screen.
Can?
They mentioned they miss everything, so they need to go back.
Oh, you guys miss
Three more
everything.
slides.
Yes. Here, screen.
Can.
Can see already. Okay, I'm not going to start again, but I'm going to share with you a little bit more, right? So we were talking about our team's role previously for interest of time, and also just a little bit more about ourselves here as well, okay? So just take a look at it, right? These are just some news articles about me and also the 987 hosting that I was talking about, okay? Let's start from here, okay? Are you able to see the screen? Let's confirm one more time before I ramble on. Can? Give me a 1, okay, if you can see the screen. I think it's all in Q&A now. Can see the screen. Great. Okay, so this is the most important part. I just want to assure you that I'm a real estate practitioner myself. So just recently, I bought an investment property at Mayor Mansion, and it was in 2022. After looking at the 99 years price of Leaf and MB, I put the trigger immediately the next day, and I was looking to cash out about 500K in terms of investments. My way of investing in real estate has always been like that. Invest young, right? And if you can invest big, of course, with prudence, do it, and then free up one name to flip property. So my name is used to buy matrimonial home, and then for Penny's name, her name is actually used to flip properties, okay? So you can see this is my very beautiful partner, and she's also our marketing director. So some portfolio that we have been, of homes that we have sold a couple of years, right? Actually just this year, so sorry. So you can see the top right is actually my own home at Twin View. If you go to our YouTube channel, you can see how we staged the entire home because it was bare, it was just TOP'd, and you know, this was one of the only few 2-bedrooms in Twin View that was actually transacted. Penthouse at Amber Sky as well, study residences, a couple of landed properties. So if you are a client of JNA Real Estate, you are in good hands because all of them are well equipped, you know, to be doing home tours as well as advising you in investments as well, okay? So we have sold till date 120 homes through video marketing and just some track record, right? So this is just the track record that we have. I'm going into the content really soon. So this is just some of the newspaper articles that we have as well. And here we are, the overview of policies. Q3 2022 cooling measures. Okay, can I just see in the Q&A section, okay, how many of y'all actually feel positive about the cooling measures? Give me a 1. How many of you actually feel negative about the cooling measures? Give me a 2. Okay, we'll open the Q&A, we'll take a look. I'm seeing 1. I'm seeing 1. I'm seeing 1. Wow, positive. Then what's the purpose of this consumer seminar? Okay, 1. Okay, great. I'm seeing it. Yeah, because it's iPad in front of me, that's why I'm looking in front. Yeah. It feels like we're balancing a live selling show and then also a consumer seminar. But I'm seeing a lot of 1s, okay? And I'm also seeing some names of my brokers there as well. Yeah. So I think after the briefing, they are positive, but I can just share with you and assure you one thing that today will be objective. There are some detriments. There are going to be some tailwinds and headwinds, right? That's going to happen in this market. And just want to assure you that everything is good, okay? So maybe I can share my screen. Yeah. Okay, great. All right. So what are the policy changes that are happening this season, okay, this cooling measure? Firstly, we have that 15-month wait-out period that took the market by storm, right? Private property owners as well as ex-private property owners are now required to serve a 15 months without period after the disposal of their private properties before they are eligible to buy a non-subsidized resale flat, right? It doesn't affect subsidized resale flats at all because it still remain unchanged at 30 months, and seniors aged above 55 years and above are able to downgrade to a 4-room or a small resale flat without such restrictions. However, seniors who, or even young couples like us who are under the age of 55, we don't have this concessionary, okay? So ECs that have reached the 5 years mark, just to let you all know, because there are a lot of questions on the ground about this, right, are considered privatized as well to serve that 15 months without period if the sellers were to sell their EC and decide to buy a resale HDB, okay? We have called the HDB officer, we have talked to them, and this is the policy, okay? Next thing, interest floor rates of property loans, okay? So as you can see, what happened was that the medium term interest rate for property loans to compute the TDSR, right? Just think of it as an algorithm behind where the banks will have to use a stress test, right? To see how much loan you can take has increased by 0.5%, and HDB has also increased the interest rate floor to 3% from 2.6%, okay? Later on, I'm going to summarize everything in simple English so that it's easy for us to understand and it's easy for us to digest as well, okay? So for residential properties, now it's 4% per annum instead of the 3.5% initially, whereas for non-residential properties, it's a higher of 5%. Initially, it was about 4.5%. Okay. Next up, lower LTV for HDBs, right? So as all of us know, the HDB LTV in the past used to be 85%. Now it is 80%. For LTV for private financial institutions, means bank loans, right, remains unchanged at 75%. We are getting quite a few worries on the ground where clients are asking us, does it affect the bank loan? It doesn't affect the bank loan. Bank loan LTV stays at 75%, but HDB one will reduce by 5%. And I think there's no price to guess why the government is doing this, right? Because we are seeing a lot of $1 million HDB flats being transacted. And not only that, we are seeing that the resale HDB flats ever since 2013 has been rising insanely, right? And this is actually caused by the delay of BTO's completion, as well as, a lot oversubscribing of BTOs because of construction delays during COVID. And I think this is something that a lot of us on the ground who are millennials are facing that problem, right? Are facing that struggle. We have met so many millennials who are asking us, should I buy resale HDB? And if you guys are here, you know that we asked you guys to stop buying resale HDB first, wait out for the cooling measures to come in, and now's the time, okay? But it's not going to happen immediately. The dip in prices will not happen immediately, so wait out a little longer as well, okay? All right, so how will the change in policies affect the real estate market as a whole, okay? So these are my personal opinion, right? So please take it with caution as well. But this is what I'm very, very confident in saying, right? For the 15 months wait out period, the first thing, right, which is a direct implication you're going to see, will be the decrease in buyers looking at HDB as a downgrading option, right? So there will be a spillover demand from HDB options to buy affordable mass market resale private properties with a price tag of around 800K to 1.5 million, right? Our TDSR now is about 55%, and then MSR is 30%. So half of it is about $400,000 to $750K in terms of HDB. And this is how we computed 800K to 1.5 million. So good news to those resale private owners, right? If you have a price tag around this area, I think your price is going to climb by a little eventually, okay? Next up, there will be lesser competition for first-time buyers. I'm seeing quite a number of millennials here, so congratulations to you. There will be more affordable pricing for HDBs right now, but are resale HDBs actually really the best investment option, okay? This one I'll leave it for my Director of Investments to share with you how he feels about this, all right? And last but not least, increase in demand for rental. I know, right? Rental has been so insane, right? But I'm quite certain after this policy, because of the interim period, buyers will still have to rent in the open market, and this will cause rental to climb, okay? Next up, the fourth point that I have is there will be greater headwinds for large flats, okay? Demand for $1 million HDB flats and larger flats like 5-room flats, HUDC, DBSS, EAs and EMs are expected to dip in pricing. Owners will be more sensitive in pricing. This is something that I'm quite certain on. And because you must understand one thing, right? Even for individuals aged 55 years and above, yes, they don't have the wait out period, but they only can consider 4-room or below, right? And they cannot consider above that. If they were to consider above that, there will still be the 15 months wait out period. So for millennials out there who are looking, or first-time buyers, right, who are looking for more affordable, bigger flats options, I think this is going to be a good time for you as well, okay? If you are following me, can you give me a 1? Can I see a 1 there? Am I losing you? I know there are a lot of words, but thank you so much. I'm seeing 1. Yes. Okay, because last night, I can share with you, both Chris and I worked till 5+ a.m. because we were so engrossed, right? We were so engrossed in typing everything. So these are our opinions. I'm seeing a lot of support. Thank you so much for that as well, okay? So the main question that I have, right, is should downgraders then consider private alternatives or choose the 15 months wait out period, okay? This is something that I would advise you. If you have alternative housing arrangements, and this is already settled, I think buyers can consider HDB options, especially when prices now are being corrected. Okay. However, if you don't have alternative or housing, right, and there's a problem with you because you don't have that interim housing for you to stay in the moment, right, what I suggest you to do is to think deeply about the rental that you're going to pay. Now, rental at $3,000 is quite a norm, right? Assuming 15 months, that's $45K, right? And you must understand one thing, this $45K is not being used to pay for an asset that you own, right? And now in today's rental market, most landlords that we have been serving are only accepting 2 years rental lease, which means that it's going to be a 24 months period, right? And that will be about $72,000. So think about it, right? Ask yourself, what is more important? Is it to choose something that has capital appreciation to compensate for the increase in mortgage, or is it to find an option, right, that saves your mortgage per month. I think this is your decision. This is something that you got to think about as well, right? In our team, we are all trained with this thing called the resale price gap analysis, where Chris has analyzed almost all the developments in Singapore to come up with that yardstick and that standard to choosing the right resale property. Yes, there are many individuals in the market who are asking you to buy new developments, but actually in this market right here, there are also a lot of resale options that you can consider as well. And I think that this is something that you should talk to our JNA Real Estate broker who are being trained on what the resale price gap analysis is to choose that resale property. Okay, so this is for the 15 months wait out period. Okay, so this is just a summary of what our resale price gap analysis is. We are not going to cover today because it's going to be too much things for you, right? But talk to our JNA Real Estate broker. Talk to the broker that has introduced you for this consumer webinar, okay? Next up, interest floor rate of property loans by 0.5%, okay? So firstly, of course, what's going to happen is that you're going to see a reduced loan for purchase. To give you a rough estimate, it's going to be about a 6% decrease in affordability. Means initially, if you can afford $1 million, now it's going to be about $940,000. Okay, and personally, we see greater opportunities for buyers in the new launch market, the ECs market, and also the resale HDB market, because developers as well as sellers will increase their price sensitivity, right? They will make sure that I think, right, most of them will decide to decrease the price a little bit more to make it slightly affordable due to these changes. Okay, so this is something that you guys can look out for. Talk to all the brokers and ask them what opportunities are there in the market. Don't just buy anything. This is something that I always tell people, right? Don't follow the FOMO mentality, okay? Find good valued products, all right? Okay, so next up, I have this diagram over here. After this, I'm going to send to a JNA Real Estate broker who has invited you, and you can request from them so that you can see based on your income and the current TDSR plus the stress test how much your affordability will be affected as well, okay? All right, so how will this actually affect buying and selling sentiments? Okay, so one thing that you got to note is that Singaporeans have not been maximizing their TDSR of 55%, right? Our TDSR decreased from 60% to 55%, but right now, according to a press release that's released, released by MES, right? Most of Singaporeans are actually using only up to 43% of their TDSR, right? So an increase in 6% will still be within the 55% mark of the TDSR. So I don't think this is going to be much of a concern, but of course there will be the rising interest rates that we're talking about later on as to how this is going to affect the market eventually, right? So a lot of us as Singaporeans, when we buy properties, right, we always advocate prudence. So do not max your TDSR. This is something that we advise you not to do. Unless you are young and you want to be aggressive, maybe there's something you can do, but you got to talk to a broker to make sure that you really are financially savvy first. But before that, I just want to advise all of you all this, right? That do not max up your TDSR, because affordability in real estate investments is actually key, okay? Affordability in real estate investments is actually key, okay? So the question is, should buyers and sellers wait? Okay. Personally, I feel that private sellers are likely not affected by this policy change, right? And buyers should capitalize on this season when prices are correcting, right? To get a valued buy, right? HDB sellers, I feel that you can be a little cautious in waiting because it's unlikely that the government is going to release any good news soon. Okay, and based on the past 3 rounds of real estate measures to cool the market, government has never been talking about positive things. Okay, it's never about positive things. Easing measures has not happened for a long time, right? So I don't think that easing measures are going to take place soon, especially in the climate where interest rates are rising. Okay, so this is just a cautionary note to all. Okay, so how have other cooling measures actually affect the Singapore market? So what we have done is that we have dwelled very deep into the different seasons of cooling measures, right? I'm not sure if you can see the screen. I hope you can see it, but I'm going to talk about the different cooling measures and when it actually happened, okay? So the first cooling measure, a big cooling measure that actually happened was in 2013, where the private per square foot rose from 1,104 PSF to 125 PSF, then to 1,315 PSF. And you can see that the government actually released 6 rounds of cooling measures then, whereas the HDB PSF was actually hovering about 475 per square foot only. Okay, so the LTV in October 6, 2013 actually lowered from to 60% for the first mortgage and to 40% for the second mortgage. And the second round of cooling measure that happened in 2013 was actually in January 12, where there's a ABSD of 5% for PRs and 15% for foreigners and non-individuals. Okay, I think the craziest hit was actually the decrease of TDSR to 60%, right, in June 29th, okay? And what we saw after the 2013 cooling measure was that the average private per square foot actually dropped from 1,315 PSF to 1,205 PSF. And HDB PSF actually dropped from 475 PSF to 420 PSF. So these measures were very effective. Okay, the next cooling measure that came in was actually the 2018 cooling measure, where the private per square foot actually rose from 1,308 PSF to 1,375 per square foot, right? And what happened on July 6th, right? That 2018, I still remember that day really fondly because I remembered that there were many clients who were queuing up for show flats. And later on, Chris is going to share with you how our team actually capitalized on this opportunity, and our clients managed to buy 5 to 8% lower than the actual price of the development eventually. And this is something that you got to note when choosing a development, right? I believe that most of the JNA real estate brokers have been sharing with you that break-even pricing is extremely important, and this is something that you got to take note of so that developers do not have the leeway to adjust price too much, okay? So LTV actually tightened by 5%, where LTV initially was 80% to 75%, which is as of now, right? And what happened was private property per square foot actually continued to climb. Okay, private property PSF continued to climb from 1308 PSF to 1375 PSF, right? And the average HDB PSF actually dropped from 426 to 417 per square foot. Okay, and the second most recent one, right, was the 2021 cooling measures that happened in December 16, 2021, where you see foreigners ABSD increased to 30%, TDSR decreased from 60 to 55%, and there's a reduced LTV limit for HDB from 85 to 80%. Okay, so what you see is that after this happened, the average per square foot of private and HDB continued to climb. Okay, as you are thinking about what I just mentioned, think about why private property prices continue to stay resilient and why in 2021 HDB prices actually stayed resilient as well. Yeah, I'll give you about 1-2 seconds to think about it. Yeah. Okay, if you have guessed that for HDB pricing, the main reason behind that was because it was driven by the fact that there were a delay in BTO completion and a delay in construction, you are right. Okay, so that's the reason, because people needed housing needs, and you know, a lot of our weddings got delayed because of that as well. Okay, I'm going to go deep into each cooling measure. So let's talk about the 2013 cooling measure first. Okay, the reason why I'm sharing with you this is because as we look at the past trends of cooling measures, we are then able to hypothesize how greatly affected our real estate market will be after the 2022 Q3 cooling measure. Okay, so stay with me. After this, I think we will be great advisors, and we also can look at our own portfolio and ask ourselves what we want to do as well. Okay, so this is the 2013 cooling measures. The top left, as you can see, I can point at it. Yeah, the top left here, right, is actually a box for you to seek reference from. Okay, but my comments are right here. Okay, so among the different cooling measures, that whether is it the increase in ABSD, the relaxation of SSD and LTV, right? The most impactful cooling measure was actually the reduction of the TDSR. Okay, so what you saw was that the overall residential property price actually fell by approximately 22% over a 4-year period. And do note that 5 rounds of cooling measures were introduced before the market cooled. And that season in 2013, it was close to a zero free interest environment. Okay, and that's the reason why the government wanted to cool any speculative activities. Okay, and it doesn't mean that price didn't drop, right? Actually, prices dropped, and not only that, volumes of transaction actually slumped as well. You can see the red bar charts are the volume, the blue bar charts are also volume. The red bar charts are actually HDB volume, the blue bar charts are actually private volumes. Okay, those dots that you see, right, these are actually the per square foot of private properties. Those in blue, those in red are actually the PSF of HDBs as well, right? So we see that the demand for such housing slumped. And one of the main reasons behind that is because this is almost the first few times that the government introduced a cooling measure, and not only once, 6 times consecutively, and there were a lot of uncertainty in the market, right? So in 2018, what actually happened is, despite that LTV actually tightened by 5% from 80 to 75%, overall private property, residential properties actually continued to rise. The prices continued to rise and reached the peak of 1,423 PSF in 2019. And then what happened was when COVID came in, the market actually dipped a little. Sorry, there's a typo there. Dipped a little in 2020 due to lockdown, where new developments halted temporarily the launch of some of the projects. That's why you don't see the PSF climbing up too much as well, right? And the second round of cooling measure post 2013, what you're going to notice is that it wasn't as effective as the first cooling measure in 2013, which affected buying sentiments more due to it being one of the precedent cases that happened in Singapore's real estate, right? However, also do note that the volume of transactions actually decreased as well. Okay. Last but not least, the most recent one, the 2021 cooling measure, what you're going to see is, despite the adjustments of the TDSR, LTV, and ABSD, which was supposed to curb the demand, home and rental prices actually continued to soar due to the great injection of liquidity from the Trump administration, right? And not only that, there was also very strong inflationary pressures that push our asset upwards in terms of pricing, okay? So prices of private homes as well as HDBs continued to soar. HDB saw, as I mentioned previously, was because of the delay in HDB BTO completion. And this also provides a clear signal after these three cooling measures that I've discussed, 2013, 2018, 2021, you will realize that in the pricing may not be a direct correlation with the adjustment of TDSR. Property prices may not be a direct correlation with the adjustment of TDSR. However, due to uncertainty, volume of transactions for both private and HDB owners actually dip. So the question right here is, we're going to ask ourselves, do we want to take the opportunity when people are fearful, or do we want to take the opportunity when everybody is FOMOing and buying, right? So this is a question we're going to ask ourselves, okay? So, Q3 2022 cooling measures, this is just my opinion of what may happen in the market. Okay, so there are two main things, right? Firstly, the 0.5% increase in the medium-term interest rate, and also the reduction of TDSR in December 2021 from 60 to 55% should cause a decrease in pricing. Okay, during 2022, cooling measure, the most recent one, right, there was a decrease in affordability by about 6%. But a recent one in 2021, actually affordability dipped by about 8.33%. So what happened was that the previous rounds of TDSR adjustment was actually more adverse than the current round of TDSR adjustment, right? And what you're going to see is that the impact of the 2022 cooling measures, this is my only personal opinion, right, that it will be slightly less drastic compared to the 2021 cooling measures. However, a cautionary note here is this: with the increase in interest rates in this current environment, volume of homes was still likely to dip, okay? This is my advice for all of y'all. Please do exercise prudence based on affordability and try to capitalize on high value opportunities, okay? Not expensive opportunities, I'm talking about high value opportunities in the market, especially when prices are being corrected, right? So for our sellers out there who are watching this, right, don't worry, we will continue to be more proactive in the marketing of your units and stay resilient in the pricing after slight correction, okay? Just stay resilient after slight correction. I think proactiveness in marketing is going to bring the prices of the properties to a strong level as well, okay? So the question here is, will the Singapore real estate market crash? Okay, honestly, I think for those who know the real estate market well, this is quite a far-fetched theory, right? Actually, Singapore's real estate market, in summary, would not crash. And the reason behind that is simply like this. Okay, let's take a look at the 2021 UBS research for property bubble index. Okay, and you can see that Singapore currently is ranking number 21 on the list. Okay, and not only that, another thing we're going to take a look at is the technical analysis of the property bubble. Okay, when GDP rises slightly slower than the property price, you're going to realize that there will be a decrease in affordability and there's increase in speculative activities. And this is the cause of the property bubble, right? This is something that I always tell my brokers at JNA Real Estate and my clients as well. Prices of property will crash if the property bubble bursts, right? Other than that, there are not going to be big reasons as to why property prices will crash. There will be a slump in volume, but it doesn't mean that prices will crash as well, okay? So let's take a look at the past three big events that happened pre-2010, okay? We have the 1996 Asian financial crisis, we have the 2000 dot-com bust, and we have the 2008 global financial crisis. Okay, the line in red is the GDP, the line in blue is our PPR, our property price index. And you can see for the three main seasons of this economy, you will see that there is a huge bubble that was forming where PPI was rising way rapidly than the GDP. And this shows a clear signal that affordability and speculative activities affordability was a concern and speculative activities were happening in the market. Okay, so a lot of people drew the correlation that it's because of the 1996 Asian financial crisis, economy crashed, that's the reason why property prices crashed. Actually, that's not the case. The case here is that there were already speculative activities before the economy crashed. And that's the reason why affordability was a big concern then. Okay, and if you see, after the 29th June 2013 cooling measure, after TDSR was implemented, the line in red, just to correct you again, is the real GDP. The line in blue is the property price index. You can see that there's actually no bubble. And actually, our property price is actually rising way slower than our income as well. And this is one of the biggest reasons why you see younger people are now able to buy more expensive homes, because income has risen very, very fast, right? I was just recently talking to a couple of two individuals, both 25, one 25 and one 26 years old. The 26-year-old was earning $10,000 working at Amazon, and the 25-year-old was earning $5,500, right? This is not something that we see very common in the past, right? But right now in this market, you are seeing a rise in income as Singaporeans are getting more and more productive, okay? So I'm not going to bore you too much about this, but we analyzed the household balance sheet to show you that the household net worth is currently 6.8 times liability. Why a strong household balance sheet is important? Because this gives us an indication whether will people liquidate the assets ASAP, right? If they don't have enough cash to circumvent the rising interest rates. And what you're seeing here is that our household net worth is 6.8 times of liability. Not only that, the free cash flow and CPF that average Singaporeans have is 2.35 times of liability as well. And last but not least, the cash that we have currently is 1.55 times of liability. We are staying afloat. And you don't see people saying that, oh dear, interest rates is rising, or you don't see people saying that, oh dear, the economy is crashing, and that's why we have to faster sell our property. In the past, used to have symptoms like this, but around the market, we are seeing a very little of such cases because Singaporeans are exercising more prudence when buying properties. Because in the past, during the 1996 Asian financial crisis, the 2000 dot-com bust, the 2008 global financial crisis, there were a lot of people who were burned during this season as well. Okay, so that's the reason why Singaporeans are exercising a lot of prudence. And this is also one of the main reasons why you're not seeing a lot of fire sale that's happening in the market, right? No fire sale, it's okay, but buy things with value so that you know that these prices will appreciate in the future. It's not going to rise as crazily in the past, neither is it going to drop drastically as compared to the past, but right now we are going for slow and steady growth in our real estate because we are already a developed nation. In the past, we used to be a developing nation as well, okay? So as you can see from this research that was done by the Asia Pacific 2021 survey, it is very obvious that Singapore is the unanimous champ, right? For the prospect ranking. Okay, what this prospect ranking is all about is that in the whole hostility of, in the whole global environment where things are getting very hostile, right? Investors are still seeing Singapore as one of the safe haven for investing, right? And our brokers on the ground are seeing a lot of foreigners coming to buy properties after the lifting of measures after COVID-19, right? And you can see there are some articles about this as well. And one of the biggest reasons why we are still a safe haven and a tax haven is because we are enjoying one of the lowest tax rates in the world, right? You can see Singapore is 20%, we have Sweden at 57%, Denmark at 55.4%, right? And that's the reason why we're seeing a lot of business owners coming in. Not only that, and also a high net worth individuals coming in because they want to pay lower tax rates, okay? And in terms of city development prospects, we are ranking number 1 as well in the world. That's why sometimes I always tell myself that I'm so thankful to be a Singaporean, even though it's so stressful here, but it's always a great economy to work in. And the government is also actively increasing the demand, where you see population-wide paper, they are already stipulated to increase the population to 6.5 to 6.9 million. And not only that, you are going to see an influx of ultra high net worth coming to the market, right? Our team at the capital markets team have been seeing a lot of ultra high net worth coming to the market to buy homes in Singapore. That's why I always tell Singaporeans out there, right? It's time for us to take action as well. Don't live in fear, but be empowered by the right education so that you can make the right decision, okay? The key is exercise prudency while making an accurate decision, okay? This is the key. But don't just wait for the market or time the market. This is something that we always advise our clients not to do, okay? So, in terms of the macro real estate investment journey that our team has been sharing since day one, okay? And this is what we have been talking about. This is based on the investment returns that our team has enjoyed for our customers. These are materialized investment returns. And you can see there is one dot that's all the way at the bottom, and that's because that wasn't the best decision. The customer was balancing both own stay as well as investment. Right, but at the top you can see, don't look at the anomaly of the 40% growth. That was actually a resale property that we analyzed and you enjoyed that growth. But most of the dots that you see around, right, above 10% to 40%, these are the returns that our customers have been enjoying for the past 3 years. Okay, so we tabulate the gains that they've materialized to see whether our investment philosophy still works in the current market. Okay, and thankfully it still does, right? So please go to every JNA real estate broker, your JNA real estate broker, and ask them for this client-centric investment planning. Okay, this is something that I will encourage you to do. Firstly, they will do a property analysis for you. Secondly, they will share with you the macro outlook. Last but not the third point they'll do is that they will do a proper portfolio analysis for you, right? Sometimes it doesn't mean that you have to sell. Okay, sometimes it means that you can just wait out the market to wait for your prices to peak. Don't have to sell, right? Sometimes it also doesn't mean that you have to buy, right? The key is still affordability, okay? And next, we are going to curate that purchase strategy for you. Then we'll do the due diligence as well as the viewing arrangements, and then the negotiation comes in, okay? So this is the investment planning that I want all you customers out there or consumers out there to go and ask your real estate broker for it as well. Okay, so what have been the system that we have been pitching in investments from day one, right? Ever since 2018, okay? This is something that we truly believe in. We don't believe in premature downgrading, and the reason behind that is because when you do premature downgrading, such measures that you are seeing right now in 2022, right, will affect us adversely. Okay, so this is just a summary. Later on, Chris is going to go deep into each age group to share with us what are the strategies that he used to be able to actually now almost being able to retire with a passive portfolio, but he's still working very hard because we have a vision to change the real estate business and real estate industry in Singapore. Okay, so when you're age 21 to 35, we call you guys the millennials. Okay, so what you got to do is that you should focus on active investment. Don't be too fearful. You have the time and the years, you have the max 30 years loan tenure to take action, right? But of course, exercise prudence as well, okay? So this is when you focus on wealth accumulation as well as high capital gain. This is when you leverage, right? And you are able to buy and flip properties. Like myself, I started with a down payment of, I think, about $300,000 in TwinView. After selling it, I was able to cash out about 500K. And this $500,000 was able to help me severely in the next down payment for my $3.8 million home, okay? So this is something that I will strongly encourage you all to practice as well, okay? When you are 35 to 45 years old, this is when you focus on estate multiplication as well as diversification, right? Capital gains and also secure some rental income so that your leverage is not too high. This is when you have families, this is when you have kids, this is when you should not leverage all the way. You should be a bit more moderate and a bit more safe in your leveraging, okay? And from 46 to 55 years old, this is when you go into the defensive property purchase strategy, okay? And this is when you reduce your leverage and you convert your active assets into passive income flows so that you're able to prepare for your retirement already, okay? 55 to 65 years old, this is when you go full force on passive investment, okay? Real estate, when it comes to residential rentals, right, it is not the only option. There are still better counterparts in the commercial as well as industrial market where you can get higher yield, right? Later, Chris is going to share with you a little bit more about this as well, okay? Okay, so capital-specific strategy happens for two groups of investors. Firstly, retail investor as well as the high net worth investment strategy. So you must ask yourself which group you are focusing on. Usually, 90% of our customers fall to the left column, where most of them are going for the short-term capital gain, appreciation, rent-to-rent, and also then converting the capital gains into passive income flows from industrial assets, okay? And when we represent funds or we represent institutional customers or investors, they usually go for land rebuilding, you know, revitalization of building, and they buy over buildings for investments, okay? So yourself, you need to know which column you are at, and if you are in the left column, which I presume most of us are under, this is when you need a specific curated strategy for you to journey with you for the next decade, right? It's no longer about that short-term capital gain flipping strategy. It works still, right? This is something that I'm doing, this is something that we are doing, but there is more after that. Right? What happens after that is the journey of being able to convert your capital appreciation into passive income flows, right? And that's when then you can actively retire in Singapore. That's getting so expensive nowadays, okay? So I'm just going to give an example of what our capital markets team has done recently to widen your perspective and horizon on the different forms of real estate investment. So our capital markets team recently brokered this deal. This was done by our commercial and industrial specialist, Justin. He sold this from freehold 4,447 square feet Mandai Estate freehold canteen. Okay, the asking was 6.8 million. We represented and we managed to help the buyer fight to a price of actually about 5.9 million, right? So these are just the examples of how we revitalize each asset to increase the rental. I want to share with you this with the main purpose of letting you know that you don't have to just solely focus on residential. As you earn more in terms of capital accumulation, you can look at industrial and commercial asset classes as well. So we actually gave 3 different scenarios for this customer because he was a minimart operator on if he were to operate a minimart, reduce stores, if you were to decrease the number of stores, what will happen, worst case scenario, best case scenario, and moderate scenario, right? We will always make sure that the worst case scenario pass before we get our customers to buy an investment because anything could have turned sour anytime, okay? Number of stores remain the same. And this is a rough analysis that we have done for them where the target price, what the target price is, which is 5.9 million. We managed to close the deal at that point, right? And also, if you take a look at the ROE, you may be wondering, 2.49% per annum. Today, you know, Singapore just released their bond, right? I think it was like above 3, it was 3 point something?
2.7.
Oh, 2.7. I think today there was like 3 point something percent, but I haven't really looked into it yet because my chat, they were all talking about it. And this is the ROE, 2.49%. It's low, but take a look at the capital gains. Estimated capital gains that we have, right? And right here you can see it's almost $1.8 million. And the reason behind that is because we negotiated a really good deal for this owner where the freehold canteen around the area were all transacting about $7 million. We got it at a good deal, okay? Where after the capital gains as well as the rental, the total ROE actually went up to about 34.5% per annum. And I tell you, this is not crypto. This is not something that is any speculative asset. This is something that you have the four walls with you. It's a stable asset class that allows you to enjoy 34.5% per annum. Okay, so what my closing thoughts are. After this slide, I'm going to pass the time on to Chris. We are going to have a short intermission first. Let me see. I took about 1 hour. Okay, great. We're on time. Okay. So these are my closing thoughts, my opinions, and my suggestions. Okay, personally, I feel that there will be a less severe change because of the less severe change in maximum loan quantum that buyers can take as compared to the December 2021 cooling measures. I feel that there will be a dip in volume. This is expected, but prices of private properties are less likely to be affected, right? Affordable private resale options for downgraders are actually likely to rise, okay? Secondly, larger HDBs, whether is it 5 rooms and above, HUDCs, DBSS, EAs, EMs, they are likely to be affected the most after this policy, okay? So this is something that I truly believe in. There will be a dip in HDB pricing and there will be stronger headwinds for this asset class. But if you are a buyer, this is going to be great opportunities for you. Sellers, please do consider progressing instead of holding on to the asset and just saying that, I want the previous pricing. Because through, marketing the home, after selling this home, liquidating this home, you may still be able to progress to active investing back into the market again, right? I always tell my customers this when they are telling me that, I could have made more money if I sold it 1 year or 2 years ago, right? I tell them this, no point crying over spilled milk, we just got to progress, right? Because we make that losses, that loss that you had previously in the next investment, right? Okay, last but not least, I feel that buyers, if you're a buyer right here, if you're a millennial looking to buy your first property, you should capitalize on the current uncertainties, but exercise prudence. Remember one thing, I think I talked about prudence countless of times, but this is something that we truly believe in. You need to make sure that you have a safety net first before you even pull the trigger, right? Talk to any of us about the opportunities in the current market. All of them are well versed with it, right? But make sure that our investment philosophy, the 5 factors that we look at, are greatly adhered to. Okay, if your broker hasn't been sharing with you these 5 factors that we look out for post 2021 cooling measures, go back to them and ask them for these 5 factors, right? If affordability is a concern, right, don't max out your loan, don't max out your TDSR, because ultimately it's not about the time, it's not about timing the market, it's about the time you have in the market. Okay. Alright, so just last closing thoughts from me before I pass the time. I have an intermission with all of y'all and then we pass the time on to Chris, right? Focus on prudent upgrading rather than premature downgrading, okay? In every crisis, there's always going to be opportunities, right? Everybody has to say this, but the key here is you got to discern, find a reliable partner to journey with you for the next decade of your real estate accumulation journey, right? Make sure that they have the ways to help you achieve your retirement dreams eventually. Okay, thank you so much. I hope that this has benefited you. We are going to take a 5 minutes intermission and then we're going to pass the time on to Chris. Okay, so stay tuned for how he actually owned 9 properties at the age of 26. Yeah. All right, see you guys. Take care.
Reaching out, I can almost see the place. Holding on with a heart that's frozen in the dark, but I am not afraid. No, I am not afraid. We'll be free, but I don't know where we're going. You and me, this is our life and we own it. Like lions in the wild. Like lions. like lions in the wild. Like lions in the wild.
Let's go. Make no excuses now. I'm talking here and now. I'm talking here and now. Let's go. Your time is running out. I'm talking here and now. I'm talking here and now. It's not about what you've done, it's about what you're doing. It's all about where you're going, no matter where you've been. Let's go. Let's go. Let's go. Let's go. Ooh, let's go. There is no better time. I'm talking here and now. I'm talking here and now. Let's go. Your time is running out. I'm talking here and now. I'm talking here and now. It's not about what you've done, it's about what you're doing. It's all about where you're going, no matter where you've been. Let's go. Let's go. Let's go. Let's go. Let's make it happen. Ooh, let's make it happen tonight. Let's make
Alright, so welcome back to this episode of JNA. Okay. Anyways, we're glad that you are back. If you are here, I hope that if that previous session actually has benefited you, do you mind giving us a 1 in the Q&A? Give us a 1 in the Q&A. Can we see? Let me open the Q&A chat box, okay? Give me a wow. Okay, I'm seeing a lot of 1. Thank you so much. I hope that I've managed to dissect all the terminologies into something that is more digestible for us as retail investors. Okay, next up, of course, we have our Director of Investments at JNA. He is the person who knows the numbers. He's the person who has created multiple portfolio strategies for the team as well as our clients, right? Before I pass the time to him, I just want to ask you all for a favor. Please do go into the Q&A chat box and then type some of your questions in, okay? At the end of today's session, let's see whether we have time to cover some of the questions that you may have, and then we'll go into Q&A after Chris's sharing, okay? So without further ado, let us welcome Chris.
All right, thank you, Jervis. It's been wonderful sharing today. So if you learned something from Jervis' webinar, do type 1 in the chat box. And I love to interact more with all of you here. The more you interact with me, the more I would love to share. All right? So thank you for typing 1. All right, thank you, Junice. All right, so let's start this webinar proper. So for my side, I'll be going to the juicy part about how do we use our real estate investment strategy, especially in a market like this, and especially when there's such a cooling measure. Okay, so let's start the meeting proper. All right, so for this, just a short introduction myself. My name is Christian. I'm the founder of investment director for JNA. So for myself, I'm one of the 7-figure investor in real estate. And I myself also own currently 9 properties, with 8 in Singapore and 1 overseas. And over the years, I decided to embark my journey in real estate investment, because that's really my passion, to help multiple property owners to earn 6-figure gains from a real estate investment. And for this, okay, I'd like to thank my client support, and most importantly, the team and JNA Systems to allow myself to be one of the property millionaire in the year of 2021. And over the years, I have been practicing what I learned from multiple property investors, from on-the-ground experience, and learning from multiple courses. And I myself invested in a total of 8 properties in Singapore. One of them is Marina One, where I bought around 150k bill valuation, now appreciate over 300k, and currently rented at around 4.4% rental yield. And not just that, helping my parents to invest into other properties, residential and commercial for myself alike, where total rental income up to date is close to 30,000, 15.5% returns per annum just on rental alone. And currently up to date, if I liquidate, the net profits are looking at almost 33.8% per annum growth. And it's something that I hope along the way today we'll be able to share a bit more about how real estate investment works and some of the fundamentals, so that we'll be able to benefit from this session. Okay, so for myself, we'll also be holding quite a few webinars about, for example, COVID-19, what are the opportunities in the market, or for example, recently the trust, the 35% ABS on trust, how do we handle in this situation right here? And subsequently, we also handle a serious investor. If you look carefully, we have, as Jace mentioned, retail investor. We also look at institution investor, where we do a discounted cash flow model. And it's something that we love to bring more insights if you're keen to find out more. And so I'm going to share a bit about my story. So some people may think that I came from a silver spoon or golden spoon or diamond spoon. But the truth is, I myself, we didn't start in a rosy picture. And I think when haters see this about real estate drowning families, they may think, wow, now real estate market may crash, things are not going well. But the truth is, real estate did drown my family. But from this, we actually learned a lesson that allowed my family to get back up again and be able to invest in real estate and now be able to retire them comfortably. So this is something that I'd like to share a very short story about my backstory. So I hope you all can pick up some nuggets along the way about some of the mistakes my parents may have made and some things to avoid. So my parents, that's the background. They actually are, one is in a civil servant as a teacher. The other is actually subsequently a housewife. They actually bought a 5-room BTO at Toa Payoh back then when I was a young little kid. So as what normal Singaporeans do, they appreciated, and of course they upgraded to the opportunity upgrade, which is the right move, to a condominium. Okay, and that's when the agent told them to buy this particular condo called Garden at Bishan. And that is when they make their first mistake, which I will share a bit more about how to avoid this kind of mistakes in real estate investment, where they over leverage. When the agent, okay, due to lack of financial literacy and adequate advice, they actually told them to buy a second Garden and Bishan. And the worst part is, after buying a second Garden and Bishan, they did not rent out at all. They didn't advise. It just left it empty for 1 year. And it's quite scary because if today they have rented out their property, covered the mortgage every single month, and hold on to 2 properties, the entire situation will be different. And this subsequently caused a very huge change in my family, because back then my parents, not just about buying property, but also in terms of financial literacy, which I emphasize very greatly, not just our risk investment, but also financial literacy in general, they end up sinking into financial difficulty. And they had to sell away their condo, 2 condos, one barely break even back then because they had to almost fire sale. And in fact, the other one did make a huge $150,000, which is decent, not bad. And they actually downgraded to a 3-room HDB at Ang Mo Kio. And this is where my real estate journey started, because this condominium, okay, the past 10 years, okay, ever since we stayed there, since our secondary school till when I went to real estate and sell it, the HDB depreciated by 14.16%. Okay, so maybe I like interact more with the audience over here so we can engage you, so we won't be so boring. So what do you think is the main cause of the drop in this price? Okay, so I give you 1 and 2. If you think it's because the property is old, type 1 in the chat box. Okay, if you think it's because the HDB prices are extremely high back then, type 2 in the chat box. Alright, so interacting more, I would love to see your replies on the group. Okay, 2, I see a lot, 2. Alright, okay, great. In fact, okay, the truth is both answers are correct, 1 and 2. So there's actually all these factors that we look at for investments. If you look at point number 2, to some extent, back then the real estate market had been overheated for HDB, and when the government cooling measure came in, a lot of demand for HDB actually hugely decreased. Okay, unlike now it's really not so much of suppression, huge drop, but back then the demand dropped by almost half. And coupled with the fact that this is a very old property, close to 62, 63 years old. So back then, the demand for some HDB for older flats dropped tremendously. And this caused the price, you can see on the diagram above, it dropped from the peak, it went up by 40%. So this is not scaring people, but it really happened for my family. And subsequently, learning from this, what I noticed, something very interesting is that the condo prices, if you look at it, for the past 9 years, the same time frame actually went up by 52.83%. And the Garden Bishan actually outperformed the market, looking at 62.65% gain. So recently I went to take a look at the transaction and I was shocked because if today, just one right move of renting out one property, a very simple move, renting out one property and holding on to the property and being financial literate, that's how we manage your finances. We'll share a bit more later on. You are able to gain, for two-bedder, 800,000 gains in the same time frame. And for the three-bedder, it went up by almost 905K gains. So if you hold both, this could have made $1.7 million. So you think it's amazing, 1.7 million in 9 years? Okay, type 1 in the chat box. Okay, I love to see more reply. 1 in the chat box. So this is very real, where one choice, one wrong move without the right advice is able to put you back by a huge opportunity gain loss. Where one, you lost 40K, the other made 1.7 million. And I went in to dissect. If today my parents are planning to retire, my dad is 56 this year, there's a very prime age to retire. Back then, I mean, if I'm not in real estate, if they will hold this property, the total sale price add together is almost 3 million, minus outstanding loan, they will have cash out a total equity of 2.4 million. This is excluding any saving. Imagine 14 years, 15 years, they just spend whatever they have and they just sell away the property. It will make 2.4 million cash out. And if you add rental in for the past 9 years, you have made 3.1 million. And this is something that's crazy because this property is not found in a CCR, OCR, but of course there are different varying strategies for investment. But just one move of holding on and renting out and the invest strategy that's so simple, you retire back for the same 3-room Ang Mo Kio, which they love Ang Mo Kio, they really love it, with cash proceeds of 2.8 million, they could have already retired and put in normal funds that can give them almost close to $20,000 per month actually, if you know how to invest in real estate. And this is something that it shocks me and got me thinking because I realized that it's just not my family, it's also about people in general. They have noticed that in Singapore, do you know that 65% of individuals don't have enough to retire and maintain their lifestyle after retirement? And this is very crazy because at the end of the day, what we see over here is that most of the people, 2/3 of them, they end up making the wrong choice, especially in real estate investment, or they have made wrong choice in financial literacy, financial prudence, and this caused them to go down the rabbit hole. And this is something that I'll share a bit more, the two contrasts. If you just make a right move and find a right broker, which you can find in JNA, they are all well trained in this, and this is something that we hope to validate to our clients because it's true intrinsic value. And subsequently, what's more scary is a lot of them, they end up with no passive income. And all these things, it actually boils down to one thing. It's because of the lack of knowledge. That's why the rich get richer, but a lot of middle income, they struggle because they are not armed with the right knowledge to actually progress forward. And that spurs us even more for JNA Real Estate to continuously push for our clients about education and educating them with the right mentality into real estate investments. And so if you look a bit more into your net worth and also into more of how you spend your daily expenses, if you want to retire at 65, assuming an individual need 2,500 per month, which is quite okay if you were to stay in a flat and just spend normally, go for holiday, maybe not go for holiday, maybe relax a bit more. Okay, that 17 years, assuming you live an 82-year-old, you will need $500,000 in your bank, okay, or maybe in your CPF. Okay, that maybe is possible with current CPF kind of savings, but I must take note, this has yet to include inflation, where if in 30 years time, this $500,000 would have dropped to $220,000, sorry. And in fact, the main reason, okay, behind this is because the government, in fact, the US, have printing money. And do you know that just in last year alone, 50% of the fiat money that's injected in the economy was printed just last year? And this is scary because it just means that typically the money value have been unknowingly been half. But it's spread. Okay, this injection is not immediate, it's spread over a series of years, but it's all stored into their safety, security deposit. And if you look even carefully, if you really think through it very, very carefully about retirement, which I hope to share a bit more financial prudence and thoughts about this. If you say you're 65-year-old this year, if you want to have $500,000 to solely spend and including inflation, at 65, you need $775,000 to save. And if you are younger, okay, assuming you want to spend at 65, retire 65 and live to 82-year-old, at the age of 45, you need at least 1.3 million by the age of 65. And at 30-year-old, if you want to start working hard now, and then at the end of the day, you go and retire 65, you need to aim by 65-year-old, you need 1.9 million, and this is each person. And this, if you assume two things. One, you live till 82, and then enjoy a good life, and then you go to heaven. Hopefully you go to heaven. Another way is assuming there is no medical fees. Okay, there's no medical fees, there's no other things, other expenses. This is something that we have to think through it. And that's when financial literacy, not just real estate, but through many different means, are very important to work together to allow you to have financial freedom. And this is something that put me into very deep thought. That's why I took out real estate degree. I went down on the ground to talk to multiple business owners and also real estate owners. How do you truly invest in property? And this is when we start to apply to my daily life. The first thing that I did, just to share about the backstory, is for my parents themselves. First thing is allow them to upgrade. My mom, high rental yield property that has around close to 10.4% rental yield per annum. And this is something very crazy to give her quite a huge pocket of money to retire her. That's one. The second thing that I did for my dad is to buy the right property. It could be resale, it could be new launch for some individuals. But for my dad's side, we bought a undervalued property that allowed it to grow by close to 250K up to date just in the past 1 year, 1.5 years. And these are things that if applied properly, just based on looking at the right values, that's when we're able to progress. And for myself, just to share a bit more, is using the funds that I save, which I'll share a bit more. How do we gain the first spot or go later on? They save, and then using the right knowledge and advice from many mentors in my life who have taught me, that's when we invest in the property, which one they include in Marina area, which now, you can see CBD area is, we bought in 2001. Now Ang Mo Kio, Amo Residence, we go in 2002, 2003. But the key thing is, it's not about timing the market, but entering the market at the right time and right opportunity. And also diversifying into commercial property, which is a very big topic, which you can approach any JNA broker to talk to them to ask more. And that's something that we hope to validate to our clients, not just a one-time transaction, buying one property, but a lifetime service. Okay, so for this, right, it will transit. How does this entire situation in the cooling measure affect the way we invest? Okay, so before I talk about the change in investment strategy, let's validate in terms of a bit more about how to be defensive in terms of this real estate investment. And defensive approach is a very key thing, especially in a volatile market. And these are three key principles, okay, that I really would like to share so that you can start a head start. So the first thing about investment philosophy is this concept of delayed gratification. And it's very important for me because even for myself, in my own business, there was a period of time when I was called to be in the MOE scholarship. I was supposed to go to MOE scholarship. But for delayed gratification, it even applies to business itself, where I decided to forfeit the bond because I see that this is lost opportunity cost, especially in business. And this translates to also financial literacy, where after earning first spot or goal, a lot of other individuals, maybe normal income earners, they also will start to spend on luxury, etc. But it's essential to be able to be very prudent in your savings, save up. We'll share a bit later on how it works, and subsequently be able or go to start investing early. And the earlier you start, the beauty of compound interest will allow you to progress by almost 3 or 4 times faster than other people, which is very, very important. We'll share later on. And subsequently, only when I invest in investment property, then I use the passive income as a source to pay for my expenses. And this is something that I hope many people are striving towards. It's not about the instant gratification, but the delayed gratification. And this is something that is very, very important, especially for many individuals in Singapore, where things are very flashy nowadays. Things are very enticing in the your discount, the Shopee, the bags, or other luxury things that seems to be very, very instant. But it's a delayed gratification that allows to transit towards financial prudence and financial freedom subsequently. So the first thing is how to get a first spot of goal as an individual, especially I know a lot of people here are young millennials. So this is a concept, a very important mindset you have to put in. So let me show you this idea of power compounding. So maybe a lot of couples are age of 25. Okay, so there are two kinds. One is an individual where age 25 is able to have parent support, and that's a great start. We can start much earlier, and as you compound, the beauty is the price increase. And there another group of couple which are using the kind of worst case scenario where age of 25, maybe one couple is working for 3 years, okay, for the girl, and for the guy maybe he just started working for 1 year plus. A 50k CPF and cash savings is something decent to start with, okay, hopefully. And if you just save 4k cash monthly, okay, don't save forever, 4k monthly. You can think back, if you are working now, you are employed, can you save this amount? If you can, it's a great start. And you only save 4k until age of 30, before you have kids, okay, which is when a family starts, okay, 4k, and then you stop saving. You just purely use this 4k that you save for 5 years to invest in property. And the beauty of it is, it will start at age 30, being early into real estate investment, okay, where your CPF you save, you should have around, if you do this very simple step as a young couple, you should get at least 360,000, okay, to start with. And if you apply our investment philosophy, which is a very crucial thing, which we're very strict about and very objective about, because we will tell clients not to buy certain property, which is very, very important, because maybe only 20% of, or even less than that, our properties can be bought, okay? And every single year, we assume 8% growth, which is very, very prudent because we have seen close to 40% gain per annum kind of returns. We have seen cases where on average 20%, so it's 60%. So I'm going on the safe side of 40% ROE returns. And you don't save anymore for age 30 or 35. These returns, okay, will go up to $504,000 age of 35. And the beauty of compounding is, okay, even don't save, it will compound. So every single cycle, 5 years, I use a very long term, usually it's 3 years, 3 to 4 years, 5 years, 700k, now it's 7k, 1.38 million, 1.9 million at age 55, when you can finally, which I linked to today's topic about the cooling measure, downgrade to a 4-room flat if you want to. This is 1.9 million of cash, assuming you don't save at all, assuming that you don't touch any of your savings. And this amount, if you know how to restructure it, you're easily able to get 7% on the safe side, return equity, passive income returns. And this is equivalent to close to $135,000 annual and $11,000 passive income per month, which on average 5 to 6k, I guess is decent. Okay, but the power comes in with if you're able, especially young couple, which I feel hard for that because young millennials, I mean, we are in the world where Instagram things are glam, we want the new things, but start saving. A simple step of just saving 4k until 30, then every single month, just save 2k. Okay, assuming you don't touch CPF at all, and CPF just grow, 2k every single month to be very, very particular, put it into real estate investment. Okay, and by the age of 55, instead of 1.9 million, you have compounded to make almost 3.2 million. And that will translate to almost close to 227k of annual income, okay, and looking at almost 18k passive income per month. And 9k per person, I guess, is quite comfortable for someone to retire, assuming that you still have more cash or CPF left aside. And this is something I want to share with a lot of millennials because it weighs my heart that saving is the way to go. On the other hand, okay, if you're age 25, okay, your same scenario, no savings to age 35, you start 10 years later. Okay, I say, never mind, just YOLO, enjoy my life. And this is something that I feel very heartbreaking when I see that in not a lot, maybe some millennials, age of 35, they start to save. They say, okay, I wake up my idea. I want to save until age 40. Then I start investing in real estate. At the age of 40, okay, after you save your CPF, including accumulation CPF, and wipe out CPF. Unlike the previous case, you didn't touch CPF at all at age of 30 onwards. you start late in risk investment, okay, decent, you will still, okay, earn 40%, 3 cycle give you 912K, and that, you think about it, okay, it's still not that bad if you have the right investment strategies, 912K, and when you put it back in the equation, it's almost half or even 1/3 the amount if you are just able to be prudent, and it starts from a monthly savings. And it's something that just simple change in mindset and lifestyle, it makes a huge difference when compounded over the years. And the worst part is, what if there is no savings? And hitting out to a lot of individuals out there, regardless you are even in real estate or in insurance or in other sectors, it's time to rethink this part and learn how to have us not just an investment strategy and also an investment mindset when it comes to saving. Okay, and the holy grail of real estate investment, if you want to summarize the beauty of it when you hit age of 55, is to allow your passive income to outweigh that of expenses, such as surplus, and then you can be able to allow a simple life where if everything is paid down, things are going fine. I mean, if it's 30K per month, that's something that I hope to help every client achieve, and that's what JNA Realtor stand for. So if any question, do ask your friend who invited you, and you can talk more to him. All right? Okay, so this will translate to my second point about a defensive real estate investment philosophy. The second part is about financial prudence. So before I talk about where to find the undervalued property, that is a very big topic itself. It's key to know about this thing called a safety net. That's something that before I look at investment property, we always tell our client to look very carefully into whether in the case where there is no income, are they able to have a proper risk management? So for example, if you're young, 35 and below, usually recommend around 6 months of mortgage for safety net. Okay, if your risk appetite is moderate, if your risk appetite is very high, of course, some go 3 months, but we usually go for 6. If very low appetite, especially in a volatile market, then we go for around 12 months mortgage. That's something that it depends on individual and depends on whether some cases, some individuals have financial backing from parents, and that is a very huge advantage. In fact, if you're 35 to 45-year-old, okay, then your risk appetite get a bit lower. That's when you need a higher safety margin of 12 months to 18 months. 46 to 55 is 24 months to 30 months, and 55 to 65, that is when we may not even want to go for safety net, or it could be just full cash and focus on passive income and rental real estate, even en bloc analysis, which is a very big topic once again. So this is something that we are very keen on to help clients for a holistic portfolio management. Okay, and okay, if you find what I'm sharing right now very interesting, very useful, type 1 in the chat box. Okay, then I would love to share more. You can see I'm very excited about investment. If I'm going too fast, then type 2 in the chat box. All right, so 1, thank you. I hope I'm not fast so that everyone can understand what I'm saying. Thank you for your support. 1. Okay, so the third part, okay, it's very important. If you want to summarize the entire main focus of real estate investment, it's a way on this concept of real estate market inefficiency. Because you are able to get data before people can get it, you are able to be on the ground, know the market, which all JNA Real Estate Realtor are trained well to. That is when we are able to take a first mover advantage and get this first dips into a property investment before people notice and the market trend notice. So when the market trend notice, the price go up, that is when we make the profits. And this is the beauty of real estate investment, because the data are actually transparent, but it's not easy to find. That's when you need the right tools and skill set and the right realtor to actually talk to you so that we can help you to transit to the next property purchase. Okay, so with this, okay, let's move on to the key topic and the key juicy part of today's webinar about how, with this cooling measure, how our property management portfolio and our strategies will change accordingly for different stakeholders. So we actually split into 4 main groups, in fact, 3 main groups. One is millennials, first-time buyers. Second is multiple property owners, and last for upgraders and downgraders. And each is a case-by-case basis. But with these new measures coming, things have changed. Things have a small tweak, and that's when, if you are keen to find out more, to talk to your realtor once again. But this is a general guideline. Okay, so this is based on what I researched and what Jervis and I have really talked for the past 2-3 days. In fact, until 4 or 5 a.m. at night, just to bring value to you. Okay, so for first one is in terms of millennials and first timers. So for first timers, if you look carefully, strategy proposal number 1, okay, there is actually a market gap. within some of the developer units, which may present attractive prices. So I'll share with you a case study later on that's quite interesting for the previous cooling measure. So for these developer units, okay, they are units that may have listed at wrong pricing last time when people bought. Okay, maybe people have bought, and subsequently there are further discount incentive pricing. But for most of them, they have been fully sold or almost fully sold. Then those are a different story. Meanwhile, if you do not need alternative housing, you can consider units with first mover advantage, and it doesn't really have to be on launch day. Some are on launch day, but some may not be. And if the housing needs are required, then you consider undervalued resale property as an alternative if you really need to go in and stay immediately. But it's all case by case basis, but this is a market gap that we have to understand how it works. And in fact, how to look at the price, okay, we have to look at development with low profit margin, which means the price they're listing is actually low, is undervalued. And that price metric is something that we have to assess. And some development which are more than 50-60% unsold may present this kind of opportunity, but may not be the case also, but most are such cases. But however, break-even price is still the utmost key criteria, utmost important to look at in terms of whether the price is right. So I'll give you an example. Okay, is if in 2018, this is shared by Jervis just now, when there was a tightening of 5% for LTV and also the TDSR, there was a change. What we saw at Affinity, okay, in Serangoon, okay, it was around 12% sold. So it was launched, it was very hot launch, first day only 12% sold. But what we saw when there was a cooling measure, it presented a short opportunity where developer, okay, it discounted by 5%, okay, and why they are able to do this case is because back then, Affinity Serangoon, when it launched at starting 1,600, even 1,007 per square feet, is they are looking at almost 40 to 50% above break even. So when it dropped to 1,004 or 1,000, close to 1,004, mid 1,004, that is when the break even price dropped below a single digit. Okay, so if you see projects that you bought last time that has a single digit break even price, you are very safe, because, or even lower, some have negative break even, that is even better. And that is when developers have to raise the price in order to make a profit. Okay, but for projects that are listed wrong pricing, they may have these particular cases where you're able to leverage on these particular opportunities to make a returns in terms of profits. And this really called a first mover advantage, where individuals back then, we had some clients actually bought, in fact, close to over 10 plus clients who bought at 1,004 pricing. Today, the current prices had transacted and made a 15% increase in prices. And if you do a return on equity returns, after netting off everything, loan, the interest, etc., they're looking at almost 47.8% return on equity, which is higher than 40% as you've seen previously. So it really depends on the project and depends on entry price. So this is just an idea, but the key thing is how to enter at the right entry price. That's when, of course, as I keep mentioning, do approach any of our JNA Real Estate Realtor, and we are able to value add in that case. Okay, and the second strategy, okay, that we look into, which is a very interesting phenomenon right now in the property market, is we see that the core central region property, okay, which is in the CBD area, if you're in city center, and the rest of central region property, the prices are starting to narrow. And it's very interesting because we can see for the past few years, the RCR property, which is the city fringe properties, have been rising in price. But the core central region property have been rising. For some that bought undervalued and make quite a lot, but for most of them, they have been on a stagnant phase. And there is a market gap. Okay, so this is opportunity that we can actually look into. And of course, we are able to understand that by leveraging on this opportunity, we are able to make a profit. And the third investment strategy with this market today about cooling measures is about HDB buyers. So, I mean, this is a group that is very important to take note. How do we approach the situation, especially when buy your first home, you're excited for resale, but you see the resale prices are high, which you predicted previously. So this scenario, you can see for the past few months, in fact, the past 1 year, we have been seeing government trying to cool the HDB market again. And this is something that cooling measure is trying to do to decrease the demand of HDB in the short term. And current situation, if we are handling quite some deal right now, we notice that there are HDB buyers who fall under the category and suffering from this particular downgrading. And because if they exercise the property but have yet to some resale application, there is a chance where HDB will actually abort the sale and reject the application. And that's when there's a pandemic, okay, pandemic is COVID, pandemonium right now in the market where sellers, after if this sale was aborted, they may price the pricing more realistically. So for individuals who are looking at first property, I know millennials here who may be looking at this, you can observe the market. If you are able to find something that is of value and below, then yes, it's great, but if you feel that the market is overheated, do wait a little more while to see how the market react. Okay, then what we notice for bigger flats, okay, for 5-room EMEA, which what Jervis mentioned previously, there is a dip in demand because, as you mentioned, some 55 or above, they can only downgrade to a 4-room flat or below. They cannot get a 5-room EA in EM. So this market may cool down. So most high-value HDB will lose demand from condo upgrading. So there may be a stagnation or in fact a slight decline of prices. So unless you plan to stay for long term, okay, for those who are looking for short-term HDB approach and to transit to a condo upgrade next time, if you are limited by cash, do consider short-term HDB 4-room flats, okay, that are able to have an easier exit strategy as compared to the bigger unit, the better. So things have changed. That's when our strategy has changed accordingly because this open a wider buyer group for you in the future when it comes to exiting. Okay, of course, this is just based on my analysis. If you have any question, to meet any one of the individual and do your due diligence. Okay, and subsequently, that is when transit to the second group of individual looking at, which is multiple property owners. So how should they invest to tally with the cooling measures? So if you look at this, based on the strategy, okay, first is to always analyze your growth potential of your asset class. Okay, so there are many different ways to analyze. And what we notice is currently, yes, the larger unit have higher growth potential. Okay, but this case by case basis, holding returns may be higher, but it once again depends on the pricing that you are looking at. And if you realize that property price has been on a slow growth, of course, your matrix of JNA matrix look at it, then you enter into a high capital gain property. If you have holding a property that has potential growth for resale, some resale, a lot of our advice for JNA Real Estate realtors, they always tell people to hold, and this is something that we need to be very objective when it comes to purchasing and selling our property. So the key thing is look at resale price gap, rental yield returns, and also look at your master plan. And second, okay, this is something that we look at. This is an example. If when to buy new launch, when to buy resale, we don't say don't buy resale, don't buy new launch, or buy one, don't buy the other. It's always based on the pricing justification. We can see this example here, where a Sengkang residences made around 9+%, but you can see the Quartz right opposite made almost 22% at the same time frame. Okay, but meanwhile, if another reverse example where you can see the M at Bugis area actually made close to 18% in the same time frame, but the resale property made 4%. So once again, this doesn't always mean resale make more or new launch make more. You must do your due diligence in terms of analyzing the pricing. And this is very important. And this translates to the second strategy in terms of multiple property owner. If you have multiple assets, how do you restructure them? So if you're holding to $1 million HDB, you must understand, which I share later on, a bit of what government is doing in terms for $1 million HDB. They want to make it affordable for people in the long-term run. So for $1 million HDB, we notice, I think mentioned by Jerry just now, where most of the pricing, they want to suppress the growth. So that's when we are noticing that this is something that we saw, that the transition asset classes, where because of the need to actually get a housing after selling the private, you may see a shift in demand from all this $1 million HDB, bigger EA flats, to perhaps older condo with larger space. And this is something that affordable range, which what Joyce mentioned, 1.5 million. These are some things that you can see the trend moving towards, where we are able to leverage on this trend to make a profit out of it. Okay, and subsequently, you can see over here a very simple thing that have been progressing in the government strategies and cooling measures is to look at the PLH model, which came out this year. There's multiple things that came out aside from the recent cooling measure, where they want to keep the public housing affordable, accessible, and inclusive. And you can see how they do it is for BTO flats that launch in the CBD area, like most of the CBD also other city fringe area even, the launching price can be higher too. So government have been always wanting to keep the price suppressed, not a huge increment. So what we notice over here is we also see a rise in demand where a shift in demand, if you look carefully over here, okay, so pardon, there are a lot of numbers, where we see more Singapore residents shifting towards condominium rather than staying in HDB. Where you can see in 2010, if you look at the chart, okay, pardon the numbers over there, you look at the chart on the right, you look at 2010, the number of condo dwellers in apartments dwellers are 11.5%. But in 2020, you can see this number rose to 16%. On the other hand, we can see the HDB, people staying in HDB, dropped from 82.4 to 78.7%. So this is driven and it's congruent with what government wants to make the HDB housing affordable, which is very important to allow a sustainable affordable housing for a long-term good lifestyle in Singapore for housing. Okay, so this is something we need to understand what government intention is along with the market trends. Okay, next part in terms of the third strategy proposal is to look into a diversification of real estate asset classes. Start to ask a bit more in terms of how can we shift this real estate class into less regulated assets like commercial property, industrial with the right pricing matrix, and sometimes even combining some funds together to look into properties that has a certain long-term growth value that may outbid that of a residential market that is slightly more regulated right now. But there are still pockets of opportunities, as mentioned just now. You have to look at the numbers, the figures, and make a right decision out of it. Okay. Subsequently, okay, that is when we transit to the last group of people, upgraders versus downgraders. Wow, this is a very, very big topic because each individual have varying different kinds of investment strategies and pricing are different. That's why it's key to look at this analysis of pricing, price gap analysis. Last time we hear people saying location, location, location. But now if I want to say the 21st century way of investing is price. Because by looking at the pricing, like doing stocks and understand intrinsic value of every single property, you're able to fill in the void and allowing us to transit the property of the right value. And of course, this season, because of the softened market to some extent, upgrading has more opportunity as compared to downgrading. But it's case by case basis. It could be the other way around, but more of upgrading. So the key thing is always not just upgrading, we can hold property even, as I mentioned, case by case, but it's to have financial prudence before you transit your next property purchase. That comes priority, especially in JNA. Okay, and if you notice, okay, there's a few case study. My parents is a very good case study where they have premature downgrading. Okay, I understand due to financial reasons and lack of knowledge, the price declined by 40K. But just by holding on the property, the opportunity cost they made is 1.7. On the other hand, if you have a delayed upgrading, okay, the interesting part, delayed upgrading, where I give a very same example, Garden and Bishan and Block 407 at Xingming, okay, which is a side by side. If this HDB by itself, if you notice, at 2011, where there's multiple cooling measures and the biggest one came in 2013. So you get heard of people who are always very fearful in the market. And the reason is very simple, because we lack the empowerment of knowledge. And that's something that education is very important, which is very, very evident about, because by having the right knowledge and education, we're able to make the right choice when the market is fearful. So there are many fearful people in the market where we see in 2011, cooling measure, they say, okay, maybe I wait a little while. I think it's too hot right now. The condo market is too hot. Wait for it to cool down. Then 2013, you realize that the market went up even fall. I said, I think it will actually fall. And yes, it did dip a bit by 5%. Then people say, okay, I think HDB market, I think can still go up. I mean, it's very common nowadays that people say, hey, let's wait. I see the market, how it goes. And we just hope that the miracle will happen and we will have some anointing from somewhere high up there and inspiration to tell me to sell. But at the end of the day, at 2013, you don't sell. 2016, you say, wow, market very bad. 2017, easing measure, wow, condo price went up again. 2018, cooling measure, wow, I think the price will fall. And 2021, another cooling measure. 2022, another cooling measure. And look at the general trend and realize that, wow, in this period of time, delay upgrading, one made 35%, okay, decent, from 2011 to 2021, 22. The other one who are able to find high growth properties and look into the right investment strategies, we see an increase by 86.54%. So at the end of the day, to wrap this up, if you notice, okay, yes, the HDB actually made 130K. Okay, pardon, this is the now example, but the property made 130K. But meanwhile, the other case of price increment went up by 62.46%, 1.7 by just upgrading when the market is fearful and knowing the pricing and intrinsic value of the price. And this is something that we are always very particular about, rather than just buying, selling, upgrading, downgrading just because of a transaction, but because it has a value that we want to bring to our clients. And we thank you for being here today, and we hope to continue partnering with you in this real estate journey. So once again, to reach out any of our JNA brokers, we always love to value add in terms of knowledge, and even if you're not ready to purchase, we believe in empowerment rather than hard selling and rather than just buying for the sake of buying or selling for the sake of selling. Alright, so that's all from my side. We'll move on to a Q&A session. Any question to put on the chat, and I'll pass the time back to Jervis.
That's right. Thank you so much for staying till the end. We're still seeing about close to 60 participants who are still surviving this analysis. We hope that we have brought value to you. That's what we wanted to do today. We promised you there was a no selling cost. Yeah, and we are seekers of the objective truth, right? So now let's open up the ground for Q&A, right? Any questions that you may have, you can send into the Q&A right now. If you still need some time to digest, I totally understand. You can talk to our JNA brokers. They were first updated before we had this consumer seminar so that they know the direction for you, okay? So now I'm going to take a look at our Q&A session for a while. I don't see any questions as of now, but it's okay. All right. So as what we mentioned previously, right? Remember, exercise prudence before making any decisions, and think of real estate as a journey rather than just going for a short-term flip. Okay. Short-term flips are instrumental for capital accumulation, but as what Chris has mentioned just now, right? The different age groups, you have different levels of safety net that we advise you to have, you know, so as to ensure, you know, that you can stay safe in this investment climate, right? And also what he mentioned, the story of having different years of people waiting and the missed opportunity cost that they have, right? Thank you so much for being vulnerable today, Chris. And if you have any questions, we'll wait out for a little while. Let me take a look. I see 16 now. Wow, okay. Come, let's take a look at this. Okay, there's a question from anonymous attendee. Okay, anyways, when will HDB resale cooling take place? Is it a time period of 3 to 6 months? Is that what you're asking about whether HDB, when do you think HDB prices, when do we think that HDB resale prices will cool? Maybe I'll pass the time on to Chris. Yeah, Chris can answer this question.
So for this question, just take note that the HDB market, usually, currently there's a lot of panic in the market right now, a lot of abortion of the OTP from time to time. So on average, I say about 3 months, but don't quote me because it may be sooner than expected. So honestly, in terms of the exact value of decrease, we won't see a huge drastic drop because, once again, I think Jervis mentioned about our TDSI and financial prudence. Singapore is quite a low property bubble condition market, so we won't see people throwing fire sale. But correction of maybe 3 to 4% could be something that we're looking at. But once again, this is based on how the market condition works. Right? So I hope that answered the question. Yes.
Yeah, great answer. I think similarly as what we've mentioned previously as well, the larger flats, the $1 million flats will be, that's what we feel, right, will be affected first. Then secondly, of course, mid-size HDBs as well. So if you're asking for the time period, I believe that usually what Chris has mentioned accurately as well, it can be a 3-month time period, but I think there will be a decrease of about 3 to even 5%. I think that is quite warranted as well. Okay, I'm seeing the next question. Let me take a look. Wow, okay. Hi, very impressive presentation and good research. That said, I'm sure nobody is right all the time, and there are going to be cases when our calculations didn't work out, definitely, right? Under such cases, what would be your exit strategy? Do you have any example? When your trade went bad, then how did you guys handle it or turn it around? Okay, I have a couple of questions coming in. I'll answer this question first. Chris, you want to take it?
All right, sure. So for exit strategy, number one, when it comes to buying a property, as I mean, financial prudence. So there are some property that you can see, there are some that buying for own stay that may not have made money because, as I mentioned, the not make money means the increment isn't as high expected because the market yet to take note of it. But as long as they're holding power, and if you just purely, for example, for pure investment, you just rent it out, purely rent it out. If you get on average around 3.5% of rental, which is quite doable in this market today with the right investment strategy, what we'll notice in the market today, if you do a slight leverage with the right prudence, you'll easily gain 7 to 8%, even without selling, just on rental itself. But if you talk about capital appreciation from most of the investment that we're looking at, most of them we are on a good roll. But the key thing is, if a case where a property does not appreciate as what we expected because of the wrong prediction, as I mentioned, there is a case to review the portfolio again. But most cases, we may allow it to, if they're intrinsic value, to rise even further. We tell people to hold a bit longer to allow the returns to come in. Okay, but the key thing here is to understand the right intrinsic value and understand the right purchase value. Okay, and if trade term back on the safe side, because we are financial prudent and we know that real estate investment is not just a speculative environment where we just try to quote a high intrinsic value, etc., just for the sake of selling, but to be objective and tell people to look at the pricing and understand the local conditions. There are a lot of small factors to look at. Then we are able to make a more informed choices. Okay, so this is something that we look out for.
Yeah.
Right? Yes.
So, sorry that I am always going to the screen because the iPad is at the center, so it keeps going there. But anyways, I love this question. Maybe I can share my personal experience and story, okay? So one thing to note is that this investment philosophy that we've come out with, right, it's after the team has served more than 400 investment clients. And not only that, also, you know, after us doing and being practitioners ourselves. And we learned this from a lot of help from a lot of mentors in the real estate industry and investors themselves as well, okay? So I'll just share my personal story in 2018 when I bought my unit at Twinview, right? I still remember I posted the whole video about it. And to be really honest, I bought that unit before the whole JNA resale price gap analysis was out, before the fact that there was this case study slide that we analyzed how people actually make profits, right? I bought it because of two things. Number one, the FOMO mentality, because I saw that everybody was at a show flat. 2018, if you remember, there was a supply glut in the market in new launches, right? And that was the only few options, right? And secondly was because of the whole fact of the high-speed rail transformation. That was how I based my investment on. Thankfully, I managed to make close to $200,000 from the investment. However, I just got to be very upfront with you that I sold the unit slightly under valuation. Okay, so when we meet a lot of our clients and they tell us that, you know, we want to wait for the property price to go up first before selling. Okay, this is my general opinion, right? I know that it gets emotional at times, but try your best not to be emotional. And the reason behind that is because we don't want to, you know, cry over wrong investments, but we want to progress in our assets, right? I think our brokers are equipped with the different case studies of High Park residences and how, you know, compared to MV residences, there were so many differences and missed opportunity costs that, you know, clients who hold on to the properties actually face. So personally, just to answer your question, as a person who has invested and made the wrong trade, I was expecting maybe 250K to 300K, right? But in the end, the high speed road didn't happen, right? And that was one reason why we always share with our customers that transformation is not everything, right? So if you make a wrong trade, it is okay. Just move on and progress and make that returns that you have missed in this investment on the next one. Okay, this is my opinion as well. Okay, let me look at the next question that you have. Thank you so much for all the questions. I'm going to scroll a bit. Give me some time. Okay, for private properties planned to sell next year, would it be a good time upon TOP treasure 2-bedroom? Okay, so personally, I have transacted I think close to 15 or 16 units at Treasure Tampines, right? But personally, I always advise my customers this, right? Try to sell upon TOP, but you don't have to wait. Okay, the reason behind that is because this. Okay, don't sell prematurely also. If you sell based on paper, personally, I don't see that the value is actually the highest, right? Usually upon TOP or 1 or 2 years after, that is quite a sweet spot. So I would suggest you, if it's not for own stay, you can sell it. But remember, after selling, ask yourself, what's the next plan? Don't just sell and let the money just, you know, leave it in the bank and then get eaten up by inflation, okay? Your broker from JNA Real Estate who has referred you to this webinar, please contact them. They'll do a proper analysis and valuation for you, and then we can advise you clearer as well. Okay. Next question that I'm seeing here: first-time single buyer, age 40. Is HDB resale private property a good strategy for 2023? Because lesser years to leverage. Okay, maybe I'll leave this question to our director of investments.
All right. Thank you. So for this question, once again, we cannot always say HDB or private because number one, first thing, before we even talk about HDB or private, we look at our clients' portfolio, their financial background, their prudence, and also in terms of their safety net. This is step one. And step two is always to look at the general market trend and how it goes. But with this market, assuming that you have the capital to invest in a HDB and private property, in the long-term run, the private property market we foresee will have a higher growth potential as compared to HDB. Because as mentioned just now by Jervis and also by myself, we see that the trend that's shifting towards, and government have been trying to suppress to make HDB affordable housing rather than a investment property. But what we notice is over the years, we're seeing a high demand for the private housing. At the same time, with the influx of foreigners, as mentioned by Jervis just now, we can see that the demand has been still shifting towards the private property, and there could be a situation where, at the end of the day, where the private property, which is will be owned by mostly foreigners or high-income earners, but the HDB market, it could be just for affordable housing, so it can keep both the parties happy to have one having happy housing, which is nothing wrong. It's a government policy to make sure things are going fine. At the same time, to attract foreign investors in to still invest in certain properties in a market that is able to tap by foreigners. So these are things that we notice in the market. That's why if you have the financial prudence settled, our main direction is always to go for a private property. Even in lesser years to leverage, the returns will still be higher as compared to a HDB, unless you're looking for a long-term own stay and investing in other asset classes.
Yeah, absolutely. I totally agree with what Chris has mentioned. One thing, right, everything that is here is not constituted as a financial advice, so ultimately the decision is yours. Personally, how I feel about your case, I'm very aligned with Chris, right? 40 years old, still not too late lah. You know, there are still a lot of years for you to leverage on, right? But ultimately, you got to ask yourself, what is it you're looking for? Is it for own stay or is it for investment, right? And if let's say the answer is investment, I would think that's why you asked about the strategy. I feel that ultimately, whether is it in the HDB market or whether is it in the private property market, if there is a valued buy, you can go for it, right? Give an example, if a HDB valuation is $800,000 and the seller is selling you at $700,000, that is a good buy, right? But if the private property is at $1 million and the seller is selling at $900,000, that's also a good buy. The key here is to have that keen eye of analysis to be able to identify what the true value of the property is versus what the actual valuation is. So I think this is something that you can talk to our JNA brokers, and they are all well trained in analyzing properties this way as well. But I love that question. Thank you so much for that question. Yeah, okay, let me see. I think there are no more questions, right? I believe most of you are taking the time to digest. Thank you so much once again for staying tuned to this webinar. We hope to see you for the next one, where we will just continuously provide you the objective opinion, because we're blessed to have all of you in our JNA family, right? Your brokers, thank them for bringing you here today as well. And if you enjoyed this thing, you can just tag us on Instagram or like us on Facebook or YouTube, almost everywhere. And you can just put us a good note for us as well. Thank you so much. We'll see you for the next one. Till the next cooling measure, hopefully not. Yeah, all right, take care. Bye-bye.
Bye-bye.
This is the moment, tonight is the night. We'll fight till it's over, so we